Hello and welcome to yet another live session. If you are here, just type yes in the comment box. And this is the first time I'm testing out on multiple platforms. This is live on Instagram, this is live on Twitter, this is live on YouTube, and it's also live on Facebook. So, four platforms simultaneously, we are live here. And if you are ready for today's amazing session, just type ready in the comment box and let's get started with this amazing session. So what I want to convey all of you is the demo of the Excel which I've shared with all of you, and we are going to do deep dive along with this session. Awesome. So what I'll do is I'll post the link of the Excel if you are not yet downloaded. Just for quick 2 minutes, I'll just give you the Excel. Just give me a second. I'll just post alongside on the video itself. Just give me a second, guys. So let me just post you a comment. Awesome. So here is the link in the chat box on YouTube. If you are watching from any other platform, just note this link down. Okay, so I'll share the link with all of you. Here is the link on the screen. Just note it down and then we'll get started. Okay, I'll explain you all the steps which it needs to be done. So first, download this Excel. It will come in your email once you put in your name and credentials. And then let's get started. Okay, so it's technofunda.co/excel. If anyone of you have not downloaded it, I'll give you 2 minutes. Just go and grab it, and let's begin the session now with the steps. Okay, so let me share the screen and let's begin with the overall journey in terms of what we will understand in this particular session. Awesome. So the Excel template which I shared with all of you looks like this, and you might all have got this template if you have downloaded right now also. I'll just remove this Excel button now and hope you are all ready with this sheet. So come with me side by side so that I can give you orientation of what needs to be done in the Excel. So sometimes when you download the Excel, it will ask you that you need to enable editing. So if at all it is asking you that, you need to start and click on that button, enable editing, so that you can use it freely. I've mentioned all other different steps over here. So first, you need to sign in on screener.in. How many of you are familiar with screener.in? Just type yes in the comment box if you are familiar with it. And if you're not familiar, it's perfectly fine. This is going to be awesome in terms of understanding and learning to the next level. So let's get into the Screener website to understand how we need to go about it. Okay. So here is how you need to go to Screener template. And you need to log in on your screener. So let me just share the screen again and let's go step by step. All of you hopefully now are able to see the screen. So if you are not signed in, you need to probably sign in on the screener first and then follow the steps. So go to the step 2 where it is written, go to this URL screener.in/excel. Okay, so here is where you need to go and just paste the link over here, and then it will ask you to upload the template. So click on the choose file wherever you have saved this template. Like for example, I have saved it in this particular folder. So I'll just click on this and it will upload, and then I need to click on upload button. So now my template is all set to be run, and now we are all set to analyze any company which you want. Okay, so let's get started how to go step by step in terms of using this entire feature. So first you need to type any name of the company. So I'm just randomly, typing name of the company. It's again one of my favorite, most well-created companies. So I'm just giving it example, but don't consider it as any kind of recommendation. So this is where you need to export to Excel. So when you click to this button, export to Excel, your Excel file will get downloaded, and I've already opened up that same file in front of you so that it's easy for you to navigate. If you are clear so far, just type clear in the comment box if these steps are very clear. So sometimes a lot of people don't even know how to use this in the first place, or how to start with this particular template. So just make sure you are getting started with this. Okay, so Dilip, what I saying, please do it again. So it's very simple. You just need to go to the first instructions tab, and there is a step 2 which is mentioned. So first sign up on screener.in website, and then you go to this particular link. Okay, so I'm pasting the link again, screener.in/excel. It will ask you to choose the file. So choose the file which you have downloaded, the Excel which I have given to you, and just click on open and then click on upload button. That is where it will get uploaded, and it is just one time exercise. Once you have done it, it's done forever. You can use this template. Any company which you are choosing, when you hit on this export to Excel button, you can pretty much download each and every company's financials. How cool this is? Just type cool in the comment box. So this is the way to download it. Somebody is mentioning there is a disturbance in the sound. Can all other members please confirm if really there is any kind of disturbance, or is it audible clearly? Okay. Superb. So those who are yet again asking for a recap, just watch this video. It is going to be there. You can just rewind this video and you can go about it. Okay. So right now just download the Excel and let's go one by one to understand different features of this Excel. So first of all, there is this link to overview tab. If you click it, it will take you to the overview. So there it is mentioned what all are the sections of this particular Excel. It also tells you, and gives you the link. In fact, it takes you to the respective tabs if you want to go through. So if I click on say income statement, it will actually take me to income statement. And then there is a navigation menu. If you click there, again, you come back over here. So there are different sections which I mentioned in the blue color. And if you want to go back to instruction tab, once you click instructions tab, it will take you over there. Now there is a tutorial which I had done in 2021. If you want to watch that, you can watch it again. But once this particular video is uploaded, I'll again replace the link over here. So you will be able to actually see this video when you click on watch screener tutorial. Okay. So if it is so far clear, just type clear in the comment box. Okay. There is small disturbance in the sound. A lot of you are saying. Let me see if I can do something around it. Okay. Is it better now in terms of sound, or is it still not clear? If it is clear, just type clear in the comment box. Okay, now it is clear. Super. So this is what we need to get started. I'll just repeat for the sake of clarity, if at all you were not able to hear properly. So this is the instructions tab. Once you click on overview tab, it will take you to the navigation menu, and all the links to different tabs are listed over there. And then you can, basically, navigate through all these things. Someone is asking, is this Excel same as the last one? No, it is actually the improvised version. There are a lot of new features. So I'll talk all the features in this particular video, right? So it is a brand new, a lot of new content I've added over here. Okay. So this is how you can go about navigate this entire thing. And then there are some other materials. If you want to visit my website, there are a lot of value additive materials over there. If you want to download my Android app where I post a lot of free videos and all that, you can download the app also. And if you want to just go and check it out, what is the TechnoFunda process, and if you want to learn more, you can also use this button to get a 10-day free email course. So that is like just more of learning. Now, once you come to the overview tab, you will see different tabs. So we'll go one by one, but before that, it is important to note this particular box. So this is like an overview box where it gives the name of the company. It gives you the current price. It gives you number of shares. What is the market cap of the company? What is the last 12 months? TTM is basically trailing 12 months. Last 12 months, what has been the net profit? What is the P ratio based on trailing profit which the company did? What is the margin? What is the latest financial year return on average equity? And what is return on average capital employed? So it gives you a bird's eye view in terms of what this Excel is all about and what company data it is. Okay. So then you go to income statement. Okay. So the first thing to go to is income statement. Now, why income statement is important? Can anybody tell me in the comment box why income statement is important? Yeah. Arpit, yes, if you are even member of my community, watch this session, because this is a brand new, template which I've shared with all of you. So it contains a lot of incremental insights. Okay. So that is where you need to get started with the income statement. Now, why income statement is important? Because anything in terms of growth of the company, it is the starting point. Now, if you don't have income, if you don't do sales, then there is nothing, right? Everything falls apart. So sales is the fundamental of any kind of business. If you want to grow in your business, the first and foremost thing is sales. So that is where, I've listed down the first key item, that is sales. Okay, so it gives you the overview of last 10 years in terms of what has been the sales of that particular company. And it also gives trailing 12 months. Then, over here, there are this growth drivers. So I'll just do the Excel here so that you can see it properly. So there is a growth trend analysis of 9 years, of 5 years, of 3 years. Now tell me why it is very important to go to such a long growth trend. Why not 1 year? Why not 2 year? Can somebody tell me in the comment box why it is important that we go deeper and we understand much better in terms of history what the company has done? Okay. Awesome. So I'm just reading the comments over here. So someone is saying, to avoid cyclical, sales and revenue rate will tell us about compounding rate. I'm just reading from my mobile so that it's easier. But I'm getting very, very interesting answers. Somebody, Ashok Daga, is saying consistency. Nilesh Dave is saying to check consistently. Awesome. To avoid cyclical companies. Yes. Great. What else? What else? Okay, rolling profits, full business cycle, fantastic. Awesome. I think a lot of you are giving interesting answers. So you are right. So the first thing is, when we are doing long-term investing, we want to see consistency of sales. We want to see consistency of margins, and we want to see consistency of different parameters to understand whether it is actually a compounding machine or it's like a cyclical company, and ultimately understand that every company is cyclical. Okay, so what we are discussing here is more of a less cyclical company. So ultimately, a lot of companies will have cycle of like 10 years or 15 years or 20 years. Everything is cyclical, right? GDP is cyclical. The, overall growth is cyclical. Human beings are cyclical. Even the overall profitability in the economy is cyclical. So here what we are trying to understand is whether that cycle is very short or it is very long. Okay, so that is what is the first point. Now, second thing is whether that company is like a consistent compounder, okay, or it is, just improving. So I classify it in the way of banyan tree, which is more of continuous growth, and I classify other side of it as a bamboo kind of company, which is like not growing earlier, but now suddenly the growth has started coming in. So if you are clear so far, just type clear on the comment box. Okay, so the idea is to find what kind of consistency the company is doing, and then we go deeper into it. Okay, so that is the whole idea around the entire process. Okay, so I shared actually one more principle which I'm just trying to search in terms of okay. So let's now move to the overall scenario. I'm just reading your comments. So yeah, compare quarters as well as yearly sales profit. So we'll go around that also. Yeah, just wait and we'll go deeper into that. So that is the first point why we are analyzing the overall journey in terms of many years. So we want to understand whether 9 years it was growing consistently, whether it was growing in 5 years period, and also growing in 3 years period. Now ideal way to find is your 9-year growth should be lesser than 3 years. So that means that the company is on a improving trajectory. Otherwise what will happen is you are looking at the past winners. I see a lot of people, they analyze company like HUL or ITC or any kind of companies which were winner earlier. Now the growth is tapering, but they just look at the past 9 years data and they feel great about it, and they say, I've got a good compounding company. But that is not true, because you have not actually factored in the degrowth which the company is going through. Okay, somebody is asking for Excel. Just see the comment section in the video on YouTube and you will find it. If you are not still able to find it, I'll just share you the Excel link so that you can quickly download and jump in. So this is the link, just download it. Now the next point is in terms of operating profit. So you want to see, the sales is growing, but the operating profit is also growing. And ultimately, we want to see the profit growth. So ideally in my checklist, when I discuss with my hackathon members also, I actually do a full hackathon, which is an implementation program in my community. There I tell people that you need to select compounding companies which has at least 10 to 12% profit growth CAGR. Okay, anything below 10 to 12% is not that great. And your PAT growth should be at least around 15%. Because if you are not growing more than 15% actually in a country like India, then it is of no use. So that is where find companies which are high in their growth rate. Now a lot of people, they try to find out companies which are high growth, but then, just on the margin fronts. Okay, so they see that the margins are improving, they are, reducing the interest cost, they are also, having some kind of other income and operating leverage. And they fall into trap. Can you tell me why they fall into trap? Because the answer here is, let's assume in your house itself, right? So suppose you are earning 1 lakh rupees in your house, and then you try to see that, I want to decrease my expenses, like operating expenses, day-to-day expenses. So what you do is, say you try to see if the electricity bulb is not switched off properly, you switch it off. You try to cut down cost on your fuel. You try to, go out less often. You avoid going to restaurant and all those things. And you ultimately decrease your cost. So ultimately, basically your margin is increasing. What happens after that? Can you consistently decrease your cost for your lifetime? Like suppose you had a 2000 rupees electricity bill. You cut corners, do all those kind of things, and then you reduced it to 1800 rupees or 1500 rupees. Can you do it forever? Like, can you take it to like a much lesser amount in your journey? Yes or no? Okay. It is not possible, right? So a lot of you are answering that it is not possible. The simple reason is all these efficiency measures and all these kind of, stuff, what you are doing is going to last for a couple of years maximum. It cannot last forever in your life. So that is where it is important to understand that you need to grow your sales. If you are not able to grow your sales, then it is of no use. As simple as that. So that is the reason you should think of sales compounding at least 10 to 12% over a long period of time. Are you all with me? Okay. So that is what you need to focus on. Okay. In terms of your journey. Now what I'll do is I'll share you a formula. Are you ready for this? Just type ready in the comment box. Okay. Just type ready in the comment box if you are ready for this formula. It is called machine formula. Okay. And I'll go deeper into it and I'll tell you along with that formula all these different things. Just give me a second. I'll just load a mind map and I'll explain to you. Okay. Just give me a second. If you are ready and excited, just type excited in the comment box, because once you understand this, nobody can, take away any kind of understanding from you. That is what you are going to do now. Okay, just give me a second. I'll just paste something on my mind map, and then I'll share the screen. Just give me a second. Okay, I'm doing real time because I like to do directly heart to heart. Whenever I feel like sharing something, I just spontaneously do it. I'm not like a traditional YouTuber who prepares too much and then does it. It's just coming directly from my heart. Okay, so let's get started. Okay, so let me share the screen, and I've just got a mind map in front of me, and this is what you need to understand if you want to find a compounding machine. Okay, this is called machine. First, you need to find a mega trend or an emerging trend. Now, this is where I'll keep connecting with the Excel. So when you see the Excel, and when you see that there is, just give me a second. I'll share the full screen so that you are able to see it. Okay, are you able to see it? Yes. So now, if you see, first thing you need to ask is whether I am finding a company which is into mega trend or into emerging trend. So if you can see a company which is continuously compounding, like its sales from anywhere between 8 to 12%, and profit, it is compounding more than 15%, most likely you have got a mega trend kind of company. Okay, and it could be the same sector also. Like if you find one company in a sector which is in mega trend, there is high probability that you will find a lot of other companies in that sector also which is into mega trend. So that is the first thing you should look out for, that whether it is mega trend or not. The second which you should look is called price volume action, institutional buying, and insider activity. Okay, so this you can actually find it out in the screener itself. So there you can see the shareholding pattern and all that. I don't know if they give it here. They don't give it here, but you need to go to your Excel screener template, not Excel screener template, the screener module, and see what kind of activities are there in the shareholding pattern. Whether FIIs are buying on an increasing trend, whether DIIs or the mutual funds are buying. Okay, and what is happening with the promoter, whether they are buying, if they are pledging, all these things you need to see. Okay, so if there is a significant action in terms of price volume, I also use one tool called ridewinners.com, where I see price volume action. So I can see a lot of companies which are coming on my screen. It pops up like this particular sector, say apparel manufacturer is coming on the screen, auto OEMs is coming on the screen. So anything which is coming in your screen and there is a price volume action, it needs your attention. Like say for example, there is one more sector like textile which is coming on the screen. Like real estate, there are so many companies which is coming on the screen. Then there is sugar and there is textile. Okay, so you know that this sector something is happening. So that is the second thing which you should watch. Action. Okay, third is you should look at competitive advantages. What are the competitive advantages? Can somebody tell me what are the different competitive advantages? So there are advantages like brand. Say for example, Nestle, it has a competitive advantage in terms of brand, the product portfolio. Some companies might be low cost producers. They might be able to produce that category of item at very, very low cost. Okay. Now, where will this reflect? Where will this reflect? It will reflect in operating profit margin. So the first clue to understand whether any company has any kind of competitive advantage or not is operating profit margin. And if some company has more than like 12% of operating profit margin on a consistent basis, see 1 or 2 years, 3 years, any cyclical company also can do it. But if it has a competitive advantage for a sustainable long period of time, then you know that some company has got something special. Okay, and there are two kinds of this competitive advantages. One is ongoing, like Nestle from many years it has competitive advantage. If you see something like Thyrocare, they have low cost advantage since many years. Some companies might have patent in their name and no company can replicate it. Some companies might be very, very strong in their R&D function, and that is where, they are very strong. Now, some other companies are emerging and building competitive advantages, and that is where you will make a lot of money. Okay, so one is your consistent compounders where you will compound at a decent rate. Another is to look at emerging companies where they are building their competitive advantages. And that is where, if you see, I have made this row green and red. So if the operating margins are increasing over a period of time, you know that this company is consistently doing something better. And what is operating margin? It is basically function of increasing your sales as well as increasing your efficiency. Okay, if you are able to command more margin, if you are able to leverage your operating leverage, then you are able to increase your margins. So if you see this company, you can see like out of 10 years, only 1 year it has dipped. Otherwise, it has been into consistently increasing territory. Okay. Same with net profit margin will give you an idea whether it is an increasing trend or not. Tax payout, again, I've done this because sometimes some companies hiding tax. So you might see like abnormal tax activity. Everything looks hunky-dory, but suddenly the tax rate is like 5%, 7%. So they are hiding something. Then also important is dividend rate. Okay, how much dividend they are paying out. I actually consider lesser dividend payout as a better thing if they are reinvesting in their business at high ROCE. I'll talk about it later, but just keep this in mind. A lot of people have this mindset that if a company is giving out maximum dividend payout, then it is a great company. It only applies where the company can grow without capital. Then it is perfectly fine. Like something like HDFC AMC or IEX, which is a platform kind of businesses, or CDSL. They don't need much of capital to grow. That is where it's perfectly fine if you have high dividend payout percentage. But if it is a company which needs capital to grow, then it is actually a bad sign if the percentage is increasing. Okay. If this is clear so far, just type clear in the comment box. If this is clear so far and making sense. Okay. Then very important metric is interest coverage ratio. What is interest coverage ratio? So it basically says, if you click on the formula on your PBT, like profit before tax, how much are you paying on your interest? Okay, so it's like this. Suppose you are earning 1 lakh rupees salary. Okay, and all your raw material, which is like your rent and day-to-day expenses, you are paid off. And then you are paid off, all other school fees and all those kind of expenses, your restaurant, going to movie and all those things. Out of that, suppose you are left with 50,000 rupees. So 50,000 you have spent in all other activity. Now you are left with 50,000 rupees. And if your EMI, the interest component itself, I am saying, okay, not even the EMI with principal, just the interest component is suppose 55,000 rupees. What does it tell about your financial situation? Will you be able to pay your EMI or you are in trouble? Of course, you are in trouble. Now, suppose your interest component is 25,000 and you are left with 50,000. What does it tell to you? It tells you that you are, 2x covered if you are wanting to pay just the interest component. And if you are just, 1x, like 50,000 is the interest and 50,000 is your leftover money, it says you are on border. You are not even able to pay the principal. You are just floating there. Okay, you will just be able to service the interest. So that is where this ratio is very, very critical. Ideally, I look at 3 times interest coverage ratio. So if you are wanting to pay 30,000 interest, your profit before tax should be at least 90,000. Okay. So here we are good. In this company, it is on a proper trend. Then there is the earnings per share and PE ratio, which is just self-explanatory. Now, a lot of time, this is very important point which I am coming to. If you want to be sharp investor, you need to do something different. I see a lot of, people who are just doing fundamental investor. They basically focus on a lot of gadha majuri. Okay, I say gadha majuri, literally it is donkey work. So they pick up a company. Suppose we are analyzing Vinati Organics. They will pick up a company and they will be in like full form. Okay, that okay, I'll do so much of fundamental analysis here. I want to be Warren Buffett. Okay, 10 years ka annual report they will download. They will download 10 years con call transcript and they will print it out everything. They will take a lot of notes and they will spend like 3 months and they will say, oh, बहुत यार in-depth study कर लिया company का, but मजा नहीं आया, this company is not that great. Okay, or they will do in-depth analysis and after reading 5 annual reports, they will figure out in one annual report that this company, this is the risk factor and this is where the company can be going into trouble. Now they do all these things and then they say investing is so difficult, it takes a lot of time. And they don't even use tools like this. I've prepared this tool for all of you. I'm sure it will cut down your research time more than 50%. That is for sure. But they don't, apply their brain. They just do hard work. Now, how I go about it, I'll just tell you. And a lot of my members, they do exact same process in my community. Okay. So you don't need to go to 10 years annual report. You see the trend. Okay. You are seeing that it is in increasing trend for 5 years. So simple thing you need to understand is ask why. What you will do? Ask why. See that why the operating margins are an increasing trend. Then open couple of con call, just press Ctrl F and see the keyword operating margin and you will get the answer that okay, because of this raw material increase or decrease or the prices of this product going up, the operating profit margins were increasing. Whatever is the reason, I'm just giving you example. Then you see the year of 2018 and you see that operating profit margin going down, net profit margin going down, tax payout going down, dividend, that is anyways immaterial, and your P ratio also slightly in, higher end. So basically there has been some aberration in the activity in this particular year. Everybody with me? So that is where you find out that, okay, there is some problem in 2018. Let's go to annual report of 2018, right? Let's try to find out what is the reason for drop in the operating profit margin. It'll take you 5 minutes to find the answer. Now, do you need to read 10 years annual report to do this? Yes or no? You don't need, okay? So apply your brain, see the aberration, see the trend and try to find answer, ask why. As simple as that. What you need to do? Ask why and then go to the report. Don't do other way around. It's like, even I tell people that, don't watch TV news channel. And some people say, why do you prefer so? Like, you need to be abreast with the company fundamentals. You need to, know what is going on. I say it's perfectly fine. I see my price volume action. If I see a company that, okay, Vinati Organics is coming in my price volume action, and then I want to find the answer that what is happening in this company, then I just Google and find out the video on YouTube and search what I need to do it. Do I need to watch 24 hours news channel to understand what is happening in company which I am analyzing? Yes or no? You don't need to watch. As simple as that. So don't get flooded with the information all around. Just use the information where you need to seek the answer. And that is where it is very, very important to ask why this is happening. And this Excel will exactly tell you how you need to, where you need to ask question and where you need to ask why. Okay. Then same way, you see that what is the competitive advantage this company is building. Like 10 years consistently, some companies increasing the operating profit margin. Consistently, they are doing last 3 years, 23% CAGR in profit. What special they are doing? Are they doing any CapEx? Are they improving their product portfolio? Are they doing more value addition? Ask those questions and you will get the answers. Okay. Then another way to look at it is this common sizing of expenses. So here it is a breakdown of all the expenses and then it again calculates the operating margin. So sales is the denominator and this is all the numerator. Okay. So it will tell you, that raw material expenses as a percentage of sales was 61%. Now you can see this trend as a decreasing trend. Can all of you see this? From 61, it has gone to 59, 47, 42 and 44. So you got your answer. Ask why. And you got your answer that raw material prices of this company is consistently going down, or the sales, margin is going up. Any one of the thing is happening. Then you see whether, fuel cost is going down or up. So you will get a trend again. Whether the employee cost is going down or up, you will get the trend again. Whether the admin cost is going down or up, it is going down. So they are becoming efficient in their selling and admin expenses. Okay. So this is how you basically analyze your income statement. Then this is the first thing. Second, you need to find your quality. Okay. So whether your company is a good quality. Now everything boils down to high return on capital employed. Okay. What is high return on capital employed? Let's come there. Okay. I'll come to this quarterly in a bit. Okay. Let's nail it down, the quarterly thing. So quarterly, it's very, very simple. Okay. So it gives you quarterly number, and this is the new feature which I've added. And you need to again see if a compounding company, like everything on a yearly basis might look hunky-dory. But what if last 2-3 quarters, they are not doing well? So you see the trend of operating margin in last few quarters. You see sequential quarter. So sequential quarter is from last quarter to this quarter, and also see yearly quarter. So last year same quarter versus this year same quarter. Why this is important? Why this is an important metric? Why this is an important metric to look at? Can anybody tell me why it is important to look at year-on-year numbers more than the quarter-on-quarter number? Okay. Yes. So yes, a lot of you are correct. So basically, why we need to use this quarter-on-quarter, year-on-year, basically, is to avoid cyclicity. Okay. So that is where you need to understand the cyclicity of the company. So say for example, there is an agri company and their monsoon quarter might be the best quarter of the year. So if you are comparing that with the last quarter, it might not make sense. Okay. So you need to understand from that perspective which quarter to compare. A lot of time people just make mistake in that quarterly comparison also. Okay. So just make sure you compare year on year quarterly growth also, like last year to this year, and then you can do sequential also. Okay. Now let's come to the ROCE part. Okay. So ultimately, any metric of quality boils down to this H of the machine. Okay, so we understood what is M. M is mega trend, where you see consistent, sales growth, profit growth. Action is where you see price volume action. You also see increasing trend of the shareholding pattern and all those triggers where institutions are buying. Then C is competitive advantage. We learned from operating margin. You can look at it. You can also look at it from working capital ratios and also ROCE. We will discuss about it. So H is high ROCE. Now ROCE is return on capital employed. Now suppose, let me give you an example. Suppose I tell you to open a shop. Okay. And it takes 1 lakh rupees to open that shop. And if you open that shop for 1 lakh rupees, at the end of the year, you will get 5,000 rupees as net profit. And then I tell you that your FD rates are 8%. And if you put 1 lakh rupees into FD, you can earn 8,000 rupees. So will you continue running that shop, or you will put money into your FD? What will you do? Simple question. Okay, your FD rate is 8%, which is risk-free. Assume that it is risk-free. Although the risk-free rate is government bond, which is slightly lower. But let's assume for now. Okay, so it's very, very simple answer. You will just shut your shop. You will go to beach of Goa, chill there. And then you put your money into FD. Still, you will be better off because mehnat nahi karna padega. And still, you are able to get 3,000 rupees extra. So this is what is hurdle rate. It is called cost of capital. Okay. So you need to make return on your capital employed more than that hurdle rate. Then only it will make sense to do the business. Now, if I tell you that you can grow infinitely, like you can grow 100% every year, ki 1 lakh rupees you have put in, if you add 1 more lakh rupees, you will get 10,000 rupees profit. Now, again, we are not talking about a loss-making company. We are still talking about a profitable company. Okay. And if I tell you that you can grow very fast, you just keep putting money on this, and you will be able to grow very, very fast. Will you like to grow? That is the whole question. Will you like to deploy more capital and grow in this situation? The answer is no. If you are a sensible person, you will say, boss, my FD is giving me more returns. Why should I put more and more money over here? Okay. So that is where the concept of ROE and ROCE comes in. So ROE is when you put your own capital and judge it on your net profit. Just the same situation which we understood. And ROCE is combined. Like if you are also taken debt and your threshold is slightly lower. So what happens is debt is cheaper. So if you take debt, it is like costing 8%, 9%. If you are calculating your equity risk, equity is highest risk, because after everyone gets, right, interest, the debtor gets, the tax government takes it. After everything else, if something is left, you get it as a net profit. So the risk or the cost of capital of equity is much higher. Okay, so generally I consider 12 to 15% as threshold. If any company is not able to make ROCE and ROE more than 15%, then it is just doing time pass. And if it is making like 7%, 6%, you are actually burning your money. How many of you are with me so far? Okay, so you need to find a hurdle rate which is much higher than 15%. Now, if you see in this particular example, the ROCE is constantly increasing, and during this entire journey, like again, I've done 9 years average, 5 years average, 3 years average. You can see it is consistently around 30 to 33%, which is a very good sign. Now, again, you need to analyze, like if at all this ROE is dropping, why it is dropping? There is something wrong probably. If ROCE is dropping, there is something wrong in that particular year. And then you go back, ask why, and then try to understand what is the reason. Everybody with me so far? Just type clear if you are so far with me. We are going very slowly, but I hope this is very valuable, because this is just like one-time exercise. Once you understand what this entire Excel is doing, it is going to like make your process so simple. Okay. Then this will give you the borrowing trend, whether the company is borrowing or the borrowing is decreasing. That is what it will tell. Fixed asset, very, very important. Some company, if you see the fixed assets are stagnating, that means they are not putting more capex into their own business. Now, again, you have to look at alongside the ROCE. If the ROCEs are like 7%, will you like a company to grow their fixed assets? No. Unless they are going to earn much more higher ROCE incrementally. You don't like to see them putting money back into the business. Okay. Then there comes a ratio called net fixed asset turnover. What is net fixed asset turnover? It is very, very simple. So net asset is basically removing the depreciation, and then you see the turnover. So say for example, I have bought this laptop, which is like Apple MacBook, say 2.5 lakhs I have bought it. Okay. So it is the price of my asset. Okay. So now if I use this laptop for like 8 hours every day, okay, and then I am able to do certain amount of sales, say 50,000 rupees or say 5 lakh rupees sales every year. Okay. So then my net asset turns will be approximately 2 times. Okay. I'm just giving very crude example. Again, it's not like perfect definition, but just to give you an idea. Now, what happens if I start using, instead of 8 hours, into 2 shifts, like 16 hours a day? What will happen? Can I make like, suppose 10 lakh rupees? Then my asset turns will increase, because my fixed cost is same for that asset. Maybe it will depreciate slightly faster, but I'm squeezing my asset much more higher. Okay. So when you are using your asset to the fullest, like if it is not remaining idle for a long period of time and you are generating sales, that is where the asset turnover ratio will increase. If it is in decreasing trend, what you need to do? What do you need to do if it is in decreasing trend? Just ask why. Why this is happening? Ask why, simple. And then go back to respective annual report or con call transcript or credit rating report to understand why in last 2 years it is decreasing in your trend. Now, one more thing very, very important which I want to share is sometimes what will happen is when a company is just doing some capex, like say for example, they've done some capex over here. Even same here, they have done some kind of capex, like they've increased the fixed asset. So it takes some 6 months to 8 months to stabilize, right? You need to do some testing, you will get new orders slowly, and you will basically slowly you will increase the operating leverage. So that is where you don't need to get concerned when there is some kind of capex which is happening. Like here also there is some capex that is happening from 475 to 751 crore and the asset turns is gone down. So that is perfectly fine. Basically they are testing out new product or new plant and it might take some time to get that fully operational and kick with full capacity. That is actually an opportunity. Now one more key parameter which I like to observe is called capital work in progress. What is capital work in progress? That is basically when you have planned a new capex, you ordered all the machinery, you are just fitting it and assembly is going on, but it is not yet ready. Okay, so it's going to come in future. So this is a very, very powerful metric. Like you see here in 2019, they had 191 crore worth of capital work in progress. And then once it has completed, it will get added into the fixed asset. So this is a very good opportunity. If you see company where the capital work in progress is increasing, you can actually be ahead of the curve in the market and you can make a lot of money because most people will be focusing on capex. You are going much early on and before the capex is on the ground, the fixed assets are already deployed, you are able to track that something is happening here. How many of you found this powerful? Great tip, right? So this one tip itself can make you a lot of money if you use it properly. Okay. Then see the borrowing again. I've done green, red so that you can understand the trend of borrowing. Receivable as a percentage of total asset. Again, receivable days gives you an idea of competitive advantage. Now take an example of COVID situation. Suppose any company is making a very, powerful drug for COVID or a medicine or a, vaccine, which is not very easily available. So if any pharma shop, they want to buy it from the company and they say that, boss, I'll pay you after 90 days. What will the company salesman tell them? I don't want to sell it to you. This guy is ready to give me advance and you are asking me 90 days to wait. I don't want to sell it to you. Okay. So the receivable days actually gives an idea of competitive advantage or the pricing power of that company. Okay. Now for certain industry, there are different norms, like say cement industry, there are norms of 60 days or 90 days. I'm just giving you hypothetical example. So you also need to look this metric in the holistic way in that particular sector. But when this number goes up, it is a problem area. It means that they are somewhere, they are giving more credit to their customers. Everybody with me? And if this number goes down, it is actually better. Same way, inventory turnover. When can you turn over your inventory very fast? When there is a lot of demand, right? You get the inventory, you churn it, you convert it into finished goods and sell it. So if you are able to turn your inventory very fast, that means you are able to generate more sales and faster sales. If the turnover goes down, that means your product is just lying, your inventory is just lying, you are not able to sell. So this number again pay a very good regard. So this will also give you idea of competitive advantage along with operating margin, along with return on capital employed. Everybody with me so far? And check out the link in the pinned box. If you want to, connect with me, I have a session also where you can learn deeper in terms of how I connect these dots in terms of my system building. So you can actually bookmark this link. Also, it is on my YouTube channel. It's pinned in your comment section and in your description also. So you can connect with me if you are not yet part of my community to learn how you can build your own system and connect all these dots. Okay, so that is where it is very, very important. Now, next is, these debt to equity ratio. Now, if a company is continuously borrowing versus whatever it has in its equity, this metric is very, very important. It's called debt to equity. So generally, I like this metric at least not more than 1x. So if it is 1x, like same proportion to equity they are taking debt, then it is fine. Ideally, I want to see this on a decreasing trend overall, and they need to basically put money through its internal accruals. Okay, so see this trend, very powerful, like borrowing trend. What is the percentage? See this trend in terms of debt to equity ratio. What is the trend? If it is an increasing trend, then you need to be alarmed that what is happening, why they are taking so much of debt. Then the most important component of any financial statement analysis is cash flow analysis. Can somebody tell me why cash flow analysis is very, very important? Why cash flow analysis is very important? So cash flow is very important because it is based on the cash versus accrual principle. Accrual principle says that I tell you, okay, you take the goods worth 5 lakh rupees. I give you the invoice. Okay, and you took the product from me. That is accrual. So as soon as I generate the sale, I need to book it. So as soon as I sold you 5 lakh rupees worth of goods, I'll put it into the sales. But the money has not come in yet. The cash has not come in yet. Now what if you default and you don't pay me back? Okay, then it will go into receivables. My receivables will jump in. Okay. Now this is a very, very important metric because a lot of people or the company who fudge their, financial statements, they use this method. So they generate fake invoices in any name, any party, and they show a lot of sales. Same way, expenses, they will just keep on doing a lot of unnecessary expenses. So that is where you need to find out whether actually the cash is coming in or not. So that is the accrual principle. Once the cash hits in, it hits into cash flow of operating activities. So that is where you need to look at this particular thing, that whatever profit after tax is there, like here it is 55 crores, then next it is 69 crores, whether it is converting into cash flow of operating activities. Now it might not get fully converted because some amount will be into working capital and different other items. But at least over a long period of time, 80% of the PAT should get converted into CFO. Okay, so that is where I have done this ratio CFO by PAT. At least 80% over a period of time. See, sometimes what happens is in one particular year they have booked it and the cash comes in next year. So then it falls in one particular year, but it jumps in the next couple of years. That is perfectly fine. Over a period of time, it should be ideally more than 80%. Okay. Then a lot of people, they get confused about free cash flow. They say, ki yaar free cash flow nahi hai, so I'll not, invest in a company. A lot of, people have that mindset. Now, what is free cash flow? Free cash flow is after your operating activities, you pay for any kind of capex. What is capex? Capex is any kind of new future growth development. Okay. So is it good that if company doesn't put into capex and gives everything as a dividend? So they generate free cash flow and then they give out as a dividend. Is that a better scenario A? Or the scenario B, where they generate cash flow from operating activities, they do a capex, almost, they do everything as a capex at a high ROCE, where they get high return on capital employed. Is that a good scenario? Scenario B. What is the good scenario? I'm just reading the comment. So scenario B is very good. Okay, I want company to put money into its own business and grow. That is where the compounding will work. Okay, but a lot of people get finicky about free cash flow. That free cash flow should be very, very high. See, that is fine in companies where they don't need capital to grow. But otherwise, you would ideally like a company to have a lesser free cash flow, reinvest into the business, and grow at a higher rate of return on capital employed. So that is where it is very important to see reinvestment rate, which is capex by CFO. Okay, if this rate is more than 30, 40, 50, 60%, and if your ROC is also very high, you have hit a jackpot. You have hit a mega compounding machine. Okay, so that is where the ROC is important. Then let's come to the I part of machine. Okay, what does I stand for? I stands for improvement. Improvement in efficiency. How you will be able to find out improvement in efficiency? You will be able to find out over here, okay, in the ratio analysis. So when you come to ratio analysis, you will see that there is improvement in the operating profit margin. That is where you are getting more and more efficient. Okay, what is other improvement area? Like product profile. If you are going into high margin product, whether you are going into better value added product, this again reflects into your net profit margin, operating profit margin. Then other improvement area is capital allocation. So if you are, deploying your capital at a higher rate of ROC, this is what it will tell you. So you check your reinvestment rate and you check your return on capital employed. That is where you know that this particular company is improving in terms of its capital allocation. Then sector dynamics, cost parameters, pricing power. As I said, all these things can be seen from working capital, receivable days, whether you have good pricing power, from your inventory turnover ratios. All these things will tell you whether you have improving pricing power or not. And cost parameters, again, the income statement, we have done this costing, what is the common size of balance sheet and income statement, both these things, common sizing, you will understand. Even here we have common sizing. Okay, so here also you will understand whether, they are doing any kind of fixed asset improvement, whether they are doing any kind of CWIP. All these things will show you improvement in terms of capacity in the business. Then you see branding, again, operating margin is a reflection of branding. ROC is a reflection of branding. So that is where I for improvement in the machine comes into the play. Next is new. Whether you are launching a new product, whether you are going into new geography, whether you have a new management, whether you are going into new category, whether you are deploying new strategy, whether you are acquiring any company. So that is where you need to see it in combination of this, what I was saying, the fluctuation. So suddenly if the sales is jumping, so same from 730, it is going to 1128. Ask why it is happening, whether it is new product, whether it is new management, whether it is going into a new geography. Any kind of new will increase your sales. It will increase your quarter on quarter performance. It will increase your operating profits if it is a high operating margin product. Okay, so that is where you need to focus on new. And then finally, most important is E, which is execution of all these earnings trigger growth. Whether they are executing properly, whether the asset turnover ratios are going up, whether the interest burden is going down. All these things will help you in that trend analysis. And there is a detailed module on ratio analysis on DuPont model. Okay, so DuPont model is basically return on equity. You break it down into three components. Whether the return on equity, what is the return on equity? Again, same example, right? If you are selling a pani puri and if you are generating 5% on 1 lakh rupees of equity, that is 5% return on equity. Whether it is because of net profit margin, whether it is because of asset turnover ratio, or just because you have taken too much of debt and you are levered. Okay, so it basically breaks down the ROE into these three components, and further the net profit margin is broken down into tax burden, interest burden, and EBIT margin. So that is how this entire thing is calculated. I'm not going deeper into it because it is a topic in itself. In my community, actually, I have one full session which I take in my ratio analysis module where I go much deeper. This is very, very powerful module and very, very helpful. And then there is graphs. Okay, so you can see the trend over a period of time, whether the net profit margin is increasing trend, operating profit margin is an increasing trend, ROE, ROC, what is going on with all these things. Now, don't delete this data sheet and don't play with the data sheet. Okay, so this is where the data gets downloaded and all the other sheet are linked with the data sheet. Okay, so this is what you need to keep it in mind. And then again, if you click on navigation menu, it will take you to all the different parts of the statement, and you can navigate whenever you want. Okay, so this is pretty much, I think, what I wanted to cover in terms of machine formula, the overview of the entire Excel, and the entire journey of how to analyze a company. Okay, if you found this useful and you are super clear, just type super clear in the comment box. And if you have any questions, we are open to questions now and we can go deep dive. And any questions you have, just go to my YouTube channel and just post it in the comment section, in the live chat section. Again, I can answer your questions now. Great. Hope it was useful, and just go to the pinned comment in the YouTube if you are watching on YouTube. And otherwise, you can just go to this link if you want to, again, connect the dots and know the end-to-end system. Okay. Awesome. Yeah, so if you have any question, just let me know. Super clear. Ashok Dagai says super clear. Sumit Tiwari saying super clear. Amarlal Vadwa is saying my first day here. Superb. Thank you. Remo is saying do a video on technical analysis. There are a lot of videos already I've done on technical analysis. Just check out my YouTube channel. And if you want to learn deeper, you can even join the community. Tirthesh Shah is saying, can you explain CFO to PAT? Okay. So CFO to PAT is basically the conversion. Okay. So your PAT is an accrual principle. Okay. So let me share the screen and you'll know what I'm talking about. So PAT is an accrual principle, and just by booking the sales, it is not taken granted that you have actually booked that sales. Okay, so it is accrual principle. To know that, you need to see the cash flow from operating activities. Okay, so once you see that, you know that the PAT is getting converted into my cash flow. So see, 1 or 2 years it is fine. See, you might have booked some profits in 2012, which is accrual, but you receive money in 2013. So that is where your cash flow from operating will jump into 2013, but it might be low in 2012. That is very normal scenario. So what you need to see is whether 80% of my profit at least gets converted into cash flow. And over a cycle, not any one particular year, because as I said, in one particular year, they might have received big profit, but they might not have received cash fully in that year, and they might have received it next year. So that is where next year it might jump. But over a cycle, like say for example, in this case, like Vinati Organics, on a cycle, it is like almost fully matching. So basically whatever profit they are booking, it is actually getting converted into cash flow from operating activity. So that is what we are learning here. Okay, is it clear? And we can take a lot of other examples. Like there are companies where there are this cash flow fudging issues and all those things. Like say Manpasand beverages. Let's take that case study. So all those things we took on the positive side. Let's see the other side. Like Manpasand beverages, there are a lot of red flags that were issued, and a lot of signs of those troubles were seen. So if you see Manpasand beverages, you will see what was the problem. So it was generating like cash flow from profit over here, but starting 2018, it was not converting it into cash flow from operating activities. So here, if you see last 3 years, it was dropping drastically. And over a period of cycle, only 2% of whatever cash flow profit they generated, they were able to convert into cash flow. Okay, rest went outside. So that is where it shows you the sign of trouble. that something is problematic over here. Okay. And if you see even income statement, you will understand what is the problem. Like suddenly, your numbers will start going down. You can see like it has started going down from 700 to 948, then suddenly 636, and then 41, and then 7. So that shows that there is some trouble. Same way, your margins trajectory is going down. All these things, automatically it will start doing red. Okay, dividend started getting dropped. The interest coverage, suddenly, it is very bad. So all these things will give you the clue. It is very, very powerful metric. Even in DuPont, if you see, it will say your tax burden somewhere it is fluctuating. Your net profit margins are going haywire. Okay, so all these things, your asset turns are badly hitting. Okay, so all these things are, the signs of trouble. Like here it is going 0.1 times. Okay. So this is way, just by looking the trend, the net fixed asset turnover is going, the receivable days, here it is going to 267 days. Okay. So this is where you know that, boss, there is something wrong in the company and it's not going fine. Okay. Is it clear? Everybody with me so far? And they probably are not even reporting the statements, I think, after a while. Let's go to screener. If they are reporting the financial statements, I think they are not even now reporting the statements. Probably it has got delisted or something. I'm not tracking it very closely. But yeah, that is how, it goes. How many of you found this powerful? This is how, just by cursory glance through, like we just glanced through for like 2 minutes and it gave you the overall idea just by this red and green. Do you need to read like 10 years annual report to figure out there is a problem in the company? No. Okay. So hope this was an eye-opener and, you understood all these concepts. So you can watch this later again if you want to. It will be there on YouTube channel. And stay connected with me. If you want to connect with me, just go to this link, technofunda.co/connect, and we can connect. Just check it out. A lot of other videos also. If you are on my YouTube channel, there are so many other powerful videos. But hope it was useful. And that's it from my end for today. Thank you so much for joining. It was almost like an hour of discussion, but hopefully it was worth it. And hopefully you'll be able to use this template very efficiently. Okay, so thanks a lot, guys. Take care and see you later. Bye-bye.